Hi, I'm Yusuf.
I'm Patrick.
And I'm Boris.
And this is our market view presentation. What is the Forex market? The Forex market is where currencies are traded. Currencies are important worldwide as it allows for businesses and business to be conducted. Foreign exchange does not occur at a central location in the world. Transactions are processed over the counter through traders linked with computer networks all over the world. Traders will buy and sell different currencies depending on the situation. Market speculation. Market speculation is making an educated guess of the direction a certain market is heading. The risk associated with speculating is high as traders make the assumption of future market positions. In this presentation, we'll be speculating the AUD and USD and the AUD and GBP markets. Determinants of exchange rates. The foreign exchange market establishes an equilibrium exchange rate at which the level of supply equals the level of demand. Economic fundamentals and other influential factors play a role in determining the equilibrium. Economic influences include relative inflation rates, commodity prices, relative economic growth rates, and relative interest rates. Other factors may include international speculation and investment, exchange rate expectations, and government intervention.
Interest rates affect consumer spending and ultimately indicates a country's economic position. With regards to Australia, the Reserve Bank of Australia has experienced a record low of 1.5%, depreciating from 1.75% in August 2016, sending optimistic messages to the market. It was essentially good news for equity investors, however bad news for the Australian dollar forecast. The latest exchange rate saw the Australian dollar approximately trading 75 cents against the US. There are prospects of a further devaluation of the Australian dollar exchange rate after Australian commodities declined drastically, bearing the slow growth in the Chinese economy. While banks see the risk to economic growth, it doesn't expect the RBA to move on interest rates, rather improve business conditions and stabilise unemployment. By comparison, the current interest rate for the US is 0.50, rising from 0.25 in January 2016. The US economy continues to recover from the GFC in 2008 and remains in a position where job prospects are on the rise. As interest rates are low, bank loans are cheap and therefore increasing demand. This increase in demand for money drives up the value of the US dollar and will potentially see appreciating the US dollar against the AUD.
The first dot point is data acquired from the Federal Reserve System. A hike in the cash rate will boost confidence in investors, therefore allowing the labour market to gain strength and more demand for the USD. And the second dot point was data acquired from the Reserve Bank of Australia, where a lower cash rate means decreased interest gains for savings and promoted spending.
There is an inverse relationship between inflation and the exchange rate. An increase in the inflation rate will potentially depreciate the currency. Australia is currently experiencing a 17-year low of 1% inflation, which is a drastic drop from its previous 1.5. Here, on average, prices are falling, which has essentially increased the demand for goods and services in Australia. This will see the Australian economy expanding its market position and allowing inflation to reach the RBA's goal of 2 to 3%, in turn appreciating the Australian dollar. Similarly, the US has a relative inflation rate of 1.1. Low or no inflation theoretically helps a country recover from a recession. With the US having both low inflation and interest rates, the cost for borrowing money for investment or borrowing money for purchases is also low. These low rates have encouraged consumption throughout the US, in turn expanding its markets. The US economy has grown beyond. The US economy grows and thereby increasing the dollar against the Australian dollar.
The first dot point, as you see, was sourced from the Bureau of Labour Statistics, and the second dot point was sourced from the Reserve Bank of Australia. And just like the last slide, these graphs are sourced by Yahoo, and they help to give a visual representation of the figures that we're presenting, and just its neat summary helps to just aid the points that we're conveying.
It is also worth considering relative growth rates of the Australian economy in comparison to the US. Taking into account the commodity prices, low commodity prices severely impacted the AUD against the US dollar. Chinese economy slowed and ultimately caused coal and iron ore prices to fall from their peaks, reaching unprecedented lows, and deeply affected the Australian economy. The AUD against the USD exchange rate forecast for 2016 led mining companies to cut costs and improve efficiency, including wage cuts and cuts to jobs, as well as the imposition of no investments. Australia is learning to adapt to a low value of the Australian dollar and very low levels in the interest rates, recognising the resource boom has ended. The RBA has adjusted its focus on understanding the strengthened labour market. This could potentially see interest rates being cut as a stimulus for the Australian economy. Moreover, the US has experienced an optimistic market in terms of job prospects, whereby increased employment has seen the growth of the economy grow beyond expectations.
This chart just once again gives a 6-month view of the AUD and USD exchange rate. At the moment, the going rate is 0.7540, and this graph just depicts, the changes in the past half year. The AUD and USD 6-month speculation. The future of the AUD USD will show increased strength in the USD. Cash rates indicate that Australia is targeting increase in expenditure, whereas USA will be targeting confidence in investors to grow businesses in terms of shares. Inflation rates show that the USA is on track to hit their 2 to 3% target, although according to the Federal Reserve System, future direction is to achieving 2%. Australia will fall short of their 2 to 3% target of 2016. This will mean that the price of AUD USD will favour the USD as demand for the stronger growing currency will increase.
So now we will look at the exchange rates between the Aussie dollar and the GBP. So the current cash rate for the GBP is 0.25%, indicating a recovery stage after the event of Brexit on June 23rd, 2016. The current cash interest rate for the Aussie dollar is 1.5%, which has depreciated from 1.75% in August 2016. This indicates that spending is the target to boost the local economy.
The first dot point was data acquired from the Bank of England, and following the Brexit event where the population voted to remove Great Britain from the EU, investors removed a substantial amount from capital and share markets, and therefore the Bank of England has lowered the cash rate to increase spending. And the second dot point was data acquired from the Reserve Bank of Australia, and it shows again that a lower cash rate means decreased interest gained for savings, and it promotes spending. And once again, these graphs just give it a summary of the figures that we've been stating, and once again sourced by Yahoo.
So now we'll look at inflation rate. The inflation rate in Australia for September 2016 is 1%, falling short of the 1.3 inflation rate at the same time last year, with estimations falling just short of the targeted 2 to 3% for the year. The inflation rate in Great Britain as of August 2016 is 0.6, meaning its target for the month. This shows that it is on par with what was expected.
Once again, the graph sourced by Yahoo.
So now we'll look at commodity prices and economic growth. Australia is a large exporter of commodities and is richer in natural resources than the United Kingdom. This would suggest that an increase in commodity prices will mean an appreciation of the Australian currency in relation to the pound. However, as Australia is isolated from the rest of the world, the country accumulates a high trade deficit. Due to events currently in China, the price of commodities is at an all-time low, which will have a negative impact on the Australian economy.
This chart just shows, once again, a 6-month view of the AUD and GBP rate. The current rate is 0.5777 and shows an unfavourable rate from an Australian's point of view. The AUD and GBP 6-month speculation. With the aftermath of Brexit in the UK, the GBP currency looks to be weak, although the future 6-month will look to be stable as inflation and cash rates are on par with expectations. The AUD will continue its growth, with both countries having lowered their cash interest rates. Increased expenditure will be on the agenda to stabilise the markets and increase growth. Although selling AUD for GBP may incur higher risks, it may achieve higher than expected returns in the future. Exchange rates. The current exchange rate for AUD USD is 0.75 as of September 19, 2016, and the current exchange rate for AUD GBP is 0.58 as of September 19, 2016. These exchange rates are current indications of how the market has been progressing, and with future outlook seemingly stable and strong, we'll look to be selling the USD at 0.77 and the GBP at 0.60 above. And finally, our trading strategy. Our trading strategy aims to sell the AUD for USD early, as future figures may indicate that the USD will grow stronger, and by purchasing GBP at an early stage may yield positive results later on, as the GBP may look to gain strength at the later stages. So based on our market speculation, our profits will be coming later on, as we're seeking higher values for the USD and GBP, which will be purchasing early. And thank you for listening.